Coming up today, stocks close lower on the back of a global bond rout, the big ruling just released on Google, stocks enter a weak period, the latest on the Fed versus Trump, and what continues to shine today. It's going to be another interesting week, guys. Let's go. And welcome back, everybody, to the Click Capital Daily Market Review. I hope you had a good long weekend. And just as I shared on Friday night, it looks like that post-Labor Day seasonality played out to a T. With all indices coming off today, and once again, a bit of weakness showing up in mega cap tech here, the largest stock in the market, NVDA, down almost 2%. But we've just had some news hit the wires after hours as I speak, causing a monster rip-up in Alphabet Google shares, up 7.42% in post-market trading on some really strong volume pushes here. Good technical signs, taking the stock up to all-time highs. And that's because we just got a ruling from a judge saying that Google will not have to sell off its dominant browser Chrome, and they're not required to cease payments to Apple and others for preloading Google product. Quite often been accused of operating a monopoly. In my opinion, it was baseless. Just goes to show what a great job they do, and it's also a testament to how strong their business really is, that this was even brought into question in the first place. And I think up until now, the market didn't even really appreciate its stronghold on the web browser market. With its global market share at 69.23%. That's up on 65% from a year ago. And if you think about it, the web browser is basically the most popular app in the world. You could kind of think of it as a gateway to other apps and websites, and very well likely to play a large part in agent AI going forward, giving Alphabet Google a really strong foothold in this important market, for which they've got the cash flow, pretty much finance anything they want to do. A lot of people don't realize Alphabet Google's the most profitable company in the world. Makes more than Apple, makes more than NVIDIA. And as my regular daily viewers know, that's why I've been banging the drum all year on how good valuation Google shares have actually been. And I couldn't believe just a few short months ago, we could have easily bought the dip at 17 times forward earnings. And like I said back then, that's over a 5% forward earnings yield. Really good for such a strong quality company, growing double digits with huge potential in front of it. Not to mention the under-discussed TPU unit, which are actually the best alternative to NVIDIA's GPU chips. Some analysts place the valuation on Google's TPU and DeepMind AI research lab at $900 billion. And so I'm going to have to call it checkmate on my theory earlier this year, around this time here, on these dips, that the market was significantly underappreciating Alphabet Google, but they would eventually wake up and realize they have the best AI model. They have strongholds, not only in the browser market, but also in video with YouTube, not to mention first mover advantage in robotaxis with Waymo. And now it's just kind of released that fears that a judge was going to try and break them up. And now we've got the stock trading at all-time highs. We have to actually zoom out here a bit. Likely to open up tomorrow around $227 a share. And as a long-term holder, I'm not selling a single share, as I still believe, even today, they're a good valuation, and they very well could overtake Apple and NVIDIA in market cap at some point over the next year, as they already make more money than both. And that judge's ruling is actually giving an uptick to Apple as well, up over 3% in post-market trading, and that too looks like it's going to gap up tomorrow around 237, making a new 6-month high. Whilst it's not really given a bump up for NVIDIA and a few other chip stocks, making lower lows here today, but of course it is for the NASDAQ Qs after hours, as Google is a significant weighting, and we're seeing a monster move here. But just getting back to the market in general, September on average is the weakest month of the year. In fact, it's got negative return looking back in history. So is today's price action a preview of what's to come? And we can see, looking back almost 100 years, there's only 3 negative months: February, May, and September, and significantly so, more than negative 1% average returns. Coming at a time when systematic traders, hedge funds, trend followers are pretty much near max long. We can see systematic strategies here in the blue line. Their equity positioning near the top end of the range, whilst discretionary investors are still actually below zero. And that's because the market's been in a great uptrend for the last 4 months. So every systematic strategy has well and truly got long, and they may actually be running out of dry powder. And just looking at some other stats, whenever the S&P is up by more than 1% in August, and we see more than 5 new all-time highs, again, most of the time we see a down month in September, pretty significantly too, negative 2.3%. And just looking at the presidential election cycle seasonality, it's also around this time we can see a bit of a correction and pullback in the market. Q3 in a post-election year. But contrasting that is we did just have a great summer. S&P finished up 9.3% between June and August. Again, that doesn't mean much for September, but the rest of the year, more than average, the market finishes higher, bar 1987, of course. But contrasting the bad stats even further is we did just have one of the strongest V-shaped recoveries ever. In fact, the S&P is up more than 25% in 100 days. That's only happened a handful of times in the last 50 years. And again, that really strong, persistent, short-term momentum bodes well for forward returns. The market higher 90% of the time a year later. And so if we are going to see a pullback in September, what could be the catalyst for that? And did we see that begin today? Financial media labeling it a global bond rout on worries over debt and tariffs. Now that Trump's tariffs have been brought into question over their legality, with the federal court ruling them mostly illegal, right after successfully negotiating with some of its largest trading partners, still in the midst of working out deals with others like China. Couldn't have come at a worse time. I think more of an actual reason we're seeing a bit of a tick up in global bond yields, especially in Europe, like I'm about to show you on the charts, is ever since Trump's come in and dialed back NATO spending. Europe's been significantly increasing their own military spending and have plans for more and more, in addition to needing to spend to secure their own energy. The strategy of relying on Russia hasn't worked out so well. And so there's a look at the Euro 30-year government bond yield, what the financial media is panicking over today, as it just broke out to a new multi-year high, 341, which by historical standards isn't all that high. In fact, I would say it's still continued normalization after we saw a lot of negative bond yields just 5 years ago in the Eurozone. No doubt these bond yields breaking out is getting people talking, pointing the finger at fiscal concerns and government debt, and of course that can imply increased borrowing costs, more expensive mortgages, business loans, government financing, etc. However, keep in mind, rising bond yields don't always signal distress. They can also reflect optimism about growth. If investors believe the global economy is stronger than expected, more government spending is not always a bad thing. And there's also a common misconception out there that when the Fed cuts rates, that is the overnight rate, short-term rates, that the 10-year yield can often do the opposite thing. In reality, the 10-year yield quite often follows the Fed. What you're looking at here in the blue line is the US government bond 10-year yield. Overlaid in the white is the Fed funds rate. And you can see they pretty much move in lockstep. When the Fed cuts rates, the 10-year bond yield goes down as well. We've seen that time and time again. Quite often, the bond market will front run the Fed. And that's because basically a lot of the time when the Fed cuts rates, they think it's warranted to do so because of the labor market and or inflation coming down or being under control. So the bond market can price that in, looking out in the future as either more weakness or lower inflation. And so if this global bond rout, as the media is calling it, was really over global growth worries, I wouldn't expect to see crude oil trade up today and finish above its 50-day VWAP, as global economic growth is linked to the demand in oil, which literally greases the wheels of the economy. Similar story for the growth commodity of copper, also ticking up today as well. There was a big global growth scare. I would expect both of those commodities to come off hard. So I would say overall, the picture today is a little mixed. I wouldn't call it a global growth scare, but no doubt global bond yields are moving up, probably in response to more anticipated government spending, meaning they have to issue more bonds, which puts upside pressure on yields as they're adding more supply into the market. But looking across other markets, yeah, we did see stocks come off, but these other key commodities are holding up pretty good. And it was also interesting to see the US dollar finish higher today as well. And generally speaking, credit markets are pretty good at sniffing out trouble. And so right now, things are super calm, looking at volatility indices across financial markets and investment grade credit spreads. That's the premium of quality bonds on top of treasuries, what investors are demanding an excess return over the safety of government bonds. Pretty low here at 79 basis points. Looking back in history, that correlates quite well with bull markets in stocks. And it's normally when we see rising credit spreads that can signal trouble, as pretty much every major bear market in stocks was preceded by rising credit spreads. In other words, bond investors demanding more of a risk premium in order to lend to companies. But no doubt we saw some interesting moves last month in markets. Quite a significant rotation actually. Most indices did okay. In fact, the S&P was up a little over 2%, but doing a lot better was small caps and micro caps, which funnily enough did a lot better than all the other indices again today. Looking at the iShares Microcap ETF, IWC. Also interesting, it put in one of its biggest volume days ever. Looks like that opening gap down dip was bought. And once again, the Russell 2000 doing a bit better than the Nasdaq Qs and the S&P 500 as well. Still technically in an uptrend here, and it's actually the Magnificent 7 that is testing their 50-day VWAP. Also interesting to see now, the market cap of NVIDIA is greater than that of the entire stock market for Canada, UK, France, and Germany. Will it overtake Japan in the next year or two? Simply incredible that one company is now worth more than some of the largest stock markets in the world. Also going against a common perception out there is manufacturing's falling off a cliff. In fact, I would say this chart is in an uptrend, and we just got the latest print on the United States ISM manufacturing new orders. And just as the name suggests, that's basically a sign of how many orders US manufacturers are receiving. Just having a significant breakout, getting back above 50, that's an expansion level. Below 50 is contraction. So are we seeing early signs of a big upwave in US manufacturing? We've heard trillions of dollars of new investments being announced over the last couple of months from other countries and companies into the United States and of course, domestic companies being strongly incentivized to produce back at home. And so that's a good sign for the US economy if we continue to see growth in manufacturing. But you don't have to have your whole portfolio in US mega cap tech stocks. Great way to get diversification is by owning a little commodities and commodity producing company. Once again, precious metals breaking out on the upside. And also again, just like we've been seeing the last couple of months, miners doing even better. And just like I made the case for last week, I think silver is offering up a much better opportunity here than gold, as gold's already well out in front over this last year or two. And just looking at the premium and discount of silver versus gold via the regression method, silver's still trading at a discount gold. And what you'll notice back in history is silver quite often go parabolic and crazy bull market. You can imagine nowadays with everyone easily able to buy it, we could see something even bigger. And it's only then when we see these big banana zones in silver that we get that huge premium over gold. And that is still yet to occur. And in fact, looks like we've got a big alligator jaw with a wide gap between silver and its premium to gold. And I'd say even way more bullish again is this chart here. And I know this data is a bit over a year old, but it's basically still the same. In fact, NVDA is now at 4.5 trillion market cap. And yes, silver miners have almost doubled in the last year. But like I said, this chart's still pretty much the same. Even if the silver mining industry was at 50 billion or even 100 billion, it's still a fraction of gold miners, the entire energy sector, and of course, just to put it into context, the biggest company in the world, which is way off the charts up here now. The point is, if big Wall Street institutional money starts waking up to silver miners, in other words, they want to show it on their quarterly reports to their managers, to their clients, in classic herding behavior you don't want to miss out, the supply of silver mining shares is so small, it can cause an epic melt-up. Add on top of that, an army of retail traders that could amplify that move. In addition to record valuation gap on miners, the low price in crude, allowing for a cheap cost to dig it up, the electrification of the world, increasing industrial demand for silver, electric vehicles, solar panels, structural supply deficit, demand already exceeding supply. I believe that's all the ingredients for a continued squeeze up in silver, like we saw again here today. Firing off another momentum upward thrust signal, big volume push higher. And like I said, doing even a bit better, silver miners. Looking at the Global X Silver Miners ETF and just going out to a monthly chart on this, looking pretty good here. Nice clean breakout to 10-year highs. And just as I share with my Stock Picks members on Sunday, I added a junior silver miner to my portfolio today, which is continuing to climb after hours as I speak, and just looking at the entire junior silver miners sector. And yes, there's an ETF for that. SILJ also looking really strong here on the chart. And in fact, I may add another junior silver miner next Monday as well, as I buy a new stock every week to increase my Stock Picks portfolio exposure to this small little sector that could actually get a lot bigger, in addition to providing great diversification. You can see it's up over 3% today, while stock indices are all down. And speaking of ETFs, stay tuned in for this Thursday, as that's when I'll be sharing a free ebook detailing my global all-weather ETF investing strategy and how I've used it to grow one of my portfolios by nearly 60% in 3 years, just by using a simple monthly ETF rebalancing strategy, significantly outperforming my fund manager's benchmark. There's proof of my returns inside this ebook, and I think you'll find this very interesting as I explain the story of how I came about to develop this strategy. So make sure you subscribe to this channel, click Capital, so you don't miss out on this when I release it on Thursday. As this strategy can be run in any account, it doesn't have to be run in a retirement account. And commodities has been part of the reason why it's been performing so well. But just moving on, I wanted to share a point that the McDonald's CEO just made, something we've been talking about this year as well. And he said middle and lower income consumers, they're under a lot of pressure. If you're upper income earning over 100K, things are good. Stock markets are near all-time highs. You're feeling quite confident about things. You're seeing international travel. All those barometers of upper income consumers are doing quite well. What we see with the middle and lower income consumers is actually a different story. They're under a lot of pressure and traffic for them is down. And so I've heard a lot of companies say this, and you can see it in consumer sentiment across different income levels. Now, this is going back to late last year. Those earning more than 100K, like the McDonald's CEO said, they're feeling pretty good. It's that wealth effect from the stock market. But for middle and low income consumers, not so great. Structural inflation is still biting. They're not really asset owners. They're not really taking part in the stock market. And I think that's an important thing to keep in mind, because a stock market correction could feed onto itself. And we kind of saw that back in March and April. The stock market came off hard during that tariff tantrum, and so did consumer spending. That pulled back a bit as well going into it. And then we saw a bit of stockpiling out of fears of pending tariffs. Then that kind of came off, normalized, and it's held up pretty good because the top 10% of consumers now represent over 50% of all consumer spending. And so it's kind of a self-reinforcing dynamic. The stock market continues doing well. Upper income consumers will keep spending on discretionary items. They've seen their portfolios holding up. There's no reason to tighten the belt. But for a lot of lower income consumers, they already feel like they're in a recession. They could really do with a couple of rate cuts, help get their cost of debt down, and also relieve some pressure on small businesses. And so I'd say now we have a really strong link between the stock market and overall consumer spending. Another point I wanted to make is this stat here has been thrown around a lot online throughout financial media, and that is the total debit balances and customers' securities margin accounts. It's basically how much leverage is out there borrowing to buy stock. And so people see this at all-time highs above $1 trillion and think that must be the reason why stocks are about to come crashing down. Keep in mind the US stock market currently valued at over $65 trillion. So this is just a small fraction of the market. And that's why you got to look at everything relatively, not in a vacuum on its own. And so we can see margin debt as a percentage of US market cap is only 1.5%. $1 trillion of 65. And that's actually well off highs of what we've seen throughout this entire secular bull market. Back in 2010, it was above 2%. And of course, it's up there as a percentage of GDP. But what you'll notice in this chart, just like long-term valuations, is a secular uptrend. Higher highs, higher lows. And so again, I don't buy the argument that margin debt is a sign that a bubble's about to come crashing down. Just moving on to the latest between Federal Reserve Governor Lisa Cook and her lawsuit against the US President Donald Trump after he fired her for committing mortgage fraud. She continues to lash out at him, not claiming she's innocent for what she's accused of, but saying that the president is not allowed to fire her for that. In fact, we've even got hundreds of economists coming to her defense, including those that used to head up the Council of Economic Advisors under Obama and Biden. Apparently, they have no problem with mortgage fraud. Even as the US Director of Federal Housing released more evidence today that there's now a third home for which Lisa Cook has claimed as being her primary residence to receive more favorable mortgage and taxation conditions, now showing proof they've been rented out to tenants. Now, can you imagine if you and I did this, or let's say one of the president's sons? We'd all be hung in public, right? But the Federal Reserve and their members and those that back them, they fall on the woke side of the fence, for which it's rules for thee, not for me. And this is apparently all okay for a Federal Reserve governor to commit mortgage fraud. Normally when that happens, the person in question takes responsibility and resigns because their peers normally give them the pat on the back and say it's time to go. So I believe the right thing would be for her to resign. Jay Powell shouldn't tolerate one of his team members breaking the law. They're supposed to be leading by example. Once again, those surrounding them continue to bend the rules. And that's why I've placed a bet for her to potentially be out by September 30. As more and more evidence surfaces of her committing mortgage fraud, she may be forced by Jay Powell to resign. So whilst obviously I don't think it's a lock, because like I said, some people believe they're above the law, but I did think it's better than a 12% chance, and hence why I placed a small bet on it, as I think it should be more closer to 50-50. And ethically speaking, it should be 100%. As like I said, normally when this happens, the person that broke the law is forced to resign. But the mainstream media and all their lapdogs are instead attacking the president for him just calling her out and asking her to take responsibility, which of course anyone with half a brain realizes that's the right thing to do. So stay tuned in here and I'll show you how that all plays out. Something else interesting today, Warren Buffett, most successful stock investor of all time, purchased his first stock when he was 14 years old, famously said he wasted the first 14 years of his life. 90% of his wealth came after age 65. Just goes to show that that compounding does take a lot of time, then it goes exponential. He recently just celebrated his 95th birthday over the weekend. Given away a lot of his wealth, he's still worth $151 billion. Another interesting piece today, front page of Barron from May 1999. Amazon.bomb. The idea that Amazon CEO Jeff Bezos has pioneered a new business paradigm is silly. He's just another middleman, and the stock market is beginning to catch on to that fact. The real winners on the net will be firms that sell their own products directly to consumers. Just look at what's happening at Sony, Dell, and Bertelsmann. And here's a look at the long-term chart of Amazon going back to early 1999. Split adjusted, it's trading around $3 a share. Here it is today at $2.25. So I thought that was interesting how wrong some of the most popular financial media publications can be, especially when they make big, bold, dramatic claims. And just wrapping it up with a look at a few charts here. Right on cue, the volatility VIX index, increasing to start September off, briefly touching its 200-day moving average before pulling back into the close. S&P 500 also touched its 50-day VWAP today before it looks like maybe the dip was bought. The Nasdaq Qs though lost the 50-day VWAP. Russell 2000 small caps still performing a lot better. Just looking at the sector breadth table, definitely got a bit of weakness here up the front. Energy sticking out and looking a little mixed on the sector trends table indicator. Bit of a bump up the front there in volatility and yields in oil. And of course, gold and silver doing well today. Got a bunch of bearish divergences building on the chart. I think if we are going to have a bit of a pullback correction, this should be the month that we see it. But of course, the big one will be the jobs report this Friday. Non-farm payroll, 4.3% unemployment rate expected. That could get things moving. And no doubt there's some fears out there with rising global bond yields, and the outperformance of gold and silver as well could be suggesting a bit of a rotation happening underneath the surface. And that's why it's important to always keep a really diversified portfolio, not being too leveraged to any one country or sector. And that's something I explain more in my ebook that I'll be releasing this Thursday. So stay locked in with Click Capital for that. Otherwise, I'll be back again tomorrow to break it all down for you again. My name's Jared, and I'll see you then. Cheers.